Hello everyone, my name is Oliver from Lux Trading and today I'm answering your question, should you trade on holidays? As a trader, you probably want to make the best out of every opportunity to get a couple pips going in your direction. You might be tempted to trade on holidays, but is it worth it? In this video, I will go over why it's not always a good idea to trade on holidays, so let's get into it. So how do holidays affect trading? Holidays affect trading by increasing the volatility of the markets in the period between the holidays and decreasing the volatility during the holidays themselves. The lower volatility means that a currency pair can be static, but in some cases, the pairs of the instruments can do some pretty unpredictable things. Most banks close during holidays. This might cause a delay in huge transactions made by institutional investors. Moreover, a good number of institutional investors are not active during the holidays. Most unusual behavior in the markets during the holidays can be attributed to the big players such as hedge funds. These players leverage so much capital that their effect on the markets are actually quite substantial. Institutional investors prefer not to be exposed during holidays, so they often protect their investments by hedging them or placing them in a safer form of investment. In this sense, hedging can mean dumping volatile assets and buying more stable, conservative type of assets. Usually, institutional traders hedge their investments in the run-up to the holidays, resulting in a lot of volatility as they're trying to buy up what is considered safe assets. After the holiday, they again assume new positions they seem preferable. Now, some holidays like Christmas are global. They affect most countries that drive the markets, including the United States and the European countries. However, some holidays are very country specific. These usually only affect currency pairs of the country where the holiday is happening. As a trader, you should definitely keep track of the major holidays in the world, or at least of those in the currencies that you're trading. Having country-specific calendars can help, so I would definitely recommend looking for one. And it's usually the wisest to not trade the currency pairs of the countries that have holidays in those specific days. You can also not trade at all during the major holidays that impact the whole world. So trading during the holidays is difficult for these reasons. Number one is that low liquidity reduces the probability of profit. One of the inherent advantages of trading these days is the huge liquidity in the markets. Traders take transactions worth trillions of dollars every single day. During the holidays, the majority of that liquidity disappears. Banks, institutional traders, hedge funds, and the institutions that make up most of that liquidity are inactive. That means that they don't provide that liquidity. That means that the liquidity is not there. And liquidity is important for you as a trader because that's what enables you to make a profit. The whole point of being a trader is to position yourself in a way where you can take advantage of the price movement. Low liquidity limits the rate of change and therefore it limits your possibility as a trader to make a profit. Number two is that heavy position offloading can actually wipe your account. During holidays, a massive percentage of traders take a break. This includes many small players, but most importantly, it includes those big players that I was speaking about. Because most of the players from the markets will not be there or they'll be away on a holiday, the support and resistance levels that you could usually expect might not be there. This means that huge changes can occur without the resistance and support that the market naturally provides. Suppose there are a few hedge funds who are active during the holiday. If they decide to offload their positions, it could significantly affect the market since there are not other hedge funds and big institutional players to absorb all that liquidity and to provide support or resistance at that level. As the positions held by big institutions are usually quite substantial, they have the ability to absorb a big offload. But during the holidays, that is not there and that can wipe out a lot of small investors with tight stops. Number three is that unreliable signals make analysis difficult. Trading signals are a huge part of trading. It's what trading plans are based off of. Traders use these signals to predict the direction of the market with the hope of getting it right and making some profit. The market gives off some pretty strong signals during normal trading operations, but during the holidays, the market tends to behave abnormally. As such, the signals that it normally produces become unreliable. It becomes easier to lose money for you because you don't have the necessary knowledge to actually protect it. Moreover, it also becomes difficult for you to make money as you can't rely on the same signals you did during normal operations. If you are a day trader, trading during holidays becomes an especially bad idea. The day will probably full of quite unusual activity, and your probability of having a successful day becomes actually pretty minimal. Next one is that brokers actually raise their spreads during holidays. As you know, the spread is the difference between the bid and the ask that the broker asks for. It shows the broker's profit and it affects traders' profit. The higher the spread, the lower the money that the trader can actually make. During holidays, brokers will often increase their spreads to combat the loss of profit that happens because of the less amount of transactions overall. So they have to make higher profit per transactions to keep their bottom line. After the holidays, those spreads are typically revised to the normal levels. Trading during the holidays will expose you to higher spreads, and so if you don't want to pay your broker more, you should avoid trading during major holidays. So, what is the conclusion? Trading during major holidays is a bad idea, especially if you're a day trader. The market behaves abnormally and it becomes difficult to predict in that time. Additionally, liquidity and volatility are especially low. As such, it's difficult to make a decent profit during a holiday. Some holidays actually have the opposite effect of erratic spikes, and since these are difficult to predict, you can't really take advantage of them. It's more likely that they'll work against you and you'll be incurring losses. You should also watch out for the period before and after the holidays. It can get quite volatile and treacherous. If the holiday is happening in just one country, it is the safest to not trade that currency. And if the holiday is happening all over the world, it is best to just stay out of the market, take a break, and keep your capital safe. That is gonna be all from me for today. Thank you for watching. If you liked the video, don't forget to like, share, and subscribe for more content like this in the future. And if you want to get in touch with us, feel free to contact us 24/7 on our live chat or send us an email to info@luxtradingfirm.com. Mine has been Oliver. Thank you for watching, and I'll see you in the next one.